Our multi-bagger pick for this week is Gokaldas Exports. In this video, I will explain to you why I picked this stock with all the positives which I see, and also caution you about the aspects of the poor performance of this company, for which I have organized this video as follows. Firstly, company overview, followed by the latest news, fundamental analysis, ratio analysis, technical analysis, lastly my opinion for your investments. All these topics will be covered in the next 10 minutes. As usual, I put a lot of effort in presenting this company in a comprehensive manner within a short time to you. If you want to encourage me, please do like the video and subscribe to the channel by hitting the bell icon for getting updates on my future videos. Gokaldas Exports market capitalization or market value as on 23rd July is 171.52 crores. The recent share price is rupees 40.05. 52 weeks high and lows are rupees 98.50 and rupees 27.6 respectively. Its book value is at rupees 52.91 and the share price is trading below the book value. This company is a small cap from the textile sector. Let's see the company overview. Gokaldas Exports Limited is the largest exporter of garments in India. The company manufactures blazers and pants, shorts, shirts, blouses, denim wear, swimwear, active and sportswear. The company also operates a retail chain of garments under the brand name The Warehouse. The company also has strategic alliances with various fashion giants, namely Nike, Mex, Mustang, Craig Norman, Reebok, Oxbow, Old Navy, Banana Republic, Levi's, Dockers, Matches Merchandising Group, Diesel and Puma are amongst others. In my research, I found that the company is still an active supplier for most of these brands. It has a 20,000 plus women workforce across its garment factories. Let's move to share price momentum analysis to see what it has delivered to its investors in the past. This stock has given a return of minus 900% over 10 years, or technically a value depreciation of the initial investment. It has ruined the investors' wealth in the past. It continued the same trend. 5 years returns at minus 112%, 3 years at minus 96%, 1 year at minus 87%. However, last 3 months return stands at 28%, which means if you have invested 3 months ago, then the return on your investment is 28%. This is a positive sign, and we have to check whether this stock is bottomed out with any positive news and how fundamentals are shaped in the last 5 years. Let us check the latest news. Recent quarter results are promising with increased sales, that is improved top line. The company's MD is active in the media outlets and taking an active leadership stance in promoting the company, which is a positive sign. He opposes India's dependence on Chinese products. Further, in the recent PPE kits manufacturing, it is learned that Gokaldas Exports is playing a crucial role in manufacturing and supplying around 60,000 PPE kits per day to meet the local consumption. Hence, we can conclude that the news flow is positive. Further, the company has aggressively increased the recruitment drive since last 1 year, including during these corona-driven pandemic days, which means its employee cost should increase in the financial statements. Let us see whether it is reflecting or not, and what are the other indications we are getting to make a decision whether to invest in this company or not. Let us move to the fundamental analysis. Sales turnover is called top line, and the top line is improved on a yearly basis from rupees 1122.96 crores in 2016 to rupees 1362.2 crores in 2020. There is a fall in net profits or the bottom line when we see the trend from 2016 to 2020. Bottom line took a V-curve recovery. Increased costs in the raw materials and proportionally an increment in the sales has been reflected. Unlike other sectors, the chances of influence of raw material costs in the subsequent year sales are less in this sector. Employee cost has increased drastically from rupees 121 crores in 2016 to rupees 466.99 crores in 2020. That is a fourfold increase. Does that look suspicious? Our company may plan to ramp up its operations in the coming years to emerge as a big player in its domain. In the balance sheet, reserves are improved and steadily maintained. Nothing much suspicious here, and we will check the other metrics in our ratio analysis part. We will move to financial statements and check for any other clues. Here, the depreciation has been increased. This is quite justified owing to the new accounting practices. Equity has increased from 17.39 crores to 21.41 crores over the years at face value file. This may be to adjust its debts and meet other obligations. Let's move to the ratio analysis to understand much more about the fundamentals of the company. We can see the current ratio of the company at below 1 and hovering at 0.9. The current ratio measures the capacity of the company to pay off its immediate liabilities with the immediately liquidable assets. Current assets include cash, short-term investments, receivables, inventory, etc. A current ratio of 2 is considered ideal. Companies that have a current ratio of less than 1 should be avoided. However, there should be a clear indication with the other operational metrics. The ratios in this segment of the performance like average net profit margin and the average return on equity are positive. Free cash flow growth rate is negative at minus 11.55%. In this case, it means company is spending much on the asset maintenance and development. This company's safety metrics are average and debt equity ratio is at 1.62. Usually companies that are expected to grow high in the future will spend much on capital expenditures. Most of the so-called multibaggers today have the worst debt equity ratio number in the past. Here this company, as the debt equity ratio is increasing along with the employee cost as well. This is tricky and a positive sign as well. Does that mean it is a multibagger? Net profit versus EPS graph shows that EPS earning per share has turned positive this year along with the net profit figures. From the income versus operating cash flow over the last decade, we can notice that gap is widened and narrowed down drastically. This is a good indication. And the operating cash flow is mostly maintained more than income. Here, operating cash flow is the amount of cash generated by the company's general operation. For an ideal company, the operating cash flow would normally be higher than the net income and would tend to be parallel to the net income unless in case of a huge shift in the company's strategy, which you should investigate. A huge deviation with income and normal operating cash flow depicts the possibility of accounting manipulation. Operating cash flow is a very important metric when you want to analyze how reliable a company's profit figures are. In this company, this metric seems normal and healthy. Let us not dig deep. Let us move to the shareholding. Here the bad thing is promoter shareholding is less when compared to public. However, if you dig deep, you can notice that the public shareholding comprises of individuals holding more than 1% of the company shares. Who are these individual investors? Are they proxies to the promoters or they are people like us? Please do your own research here. Let us move to the technical analysis, and it clearly shows the company has consolidated well and ready for a big breakout on the upside. Let us see how the price reacts in the future. Overall, with the given metrics and numbers from the price momentum, fundamental ratio and technical analysis, I see that the company may perform well in the future. Increasing number of corona cases is also positive for this company owing to its involvement in the manufacturing of PPE kits. Currently, this company is the top 10 PPE manufacturers in India. As we analyze in this particular sector, they may lose the business in the normal textiles. However, they may gain much in the PPE. So it's a trade-off between the sales which they make by PPE and the sales which they make when the business is as usual. Let's hope for the best. Let us move to my opinion on your investments. I conclude that Gokaldas exports may perform well in the near future with an estimated stock price CAGR at around 90.6%. Estimation of CAGR is out of the scope for this video. We will see in another video. With such an estimated CAGR number for an investment of 1 lakh in this script, your returns may be around rupees 6,92,418. The same amount in the bank at an interest rate of 6% will give you a return of rupees 1,19,668. There is no chance for more returns. In case of investing in this stock, rupees 1 lakh or part of it could be lost, but when it works out, then the returns would be high and up to 6,92,000. So it's investors' call, that is your call, to invest in Gokaldas exports, fixed deposits or any other instruments by deliberating on the risk and reward of the instruments. I have shared my opinion. Thanks for watching. Don't forget to like the video and subscribe to the channel. I will see you again in the next video. Until then, take care of yourself and your investments.